This Week in Startups is brought to you by Uber. Read all about the ways Uber is moving forward by going to uber.com/movingforward. And Weebly. Whether you're looking to create a side hustle or your dream job, Weebly can help you get there. Visit Weebly.com/twist for 15% off your first purchase.
So one of the great venture capital firms in Silicon Valley to be formed in the last decade is Social Capital Partnership. My good friend Chamath Palihapitiya started this firm, and one of his secret weapons was the experience he had growing Facebook from 10 million to 1 billion users. And the team he had there, a lot of them came over to Social Capital, and what Social Capital does better than any other firm is analysis of data and growth strategies, in my mind. And AndyArtz is a partner at Social Capital. He came here from halfway around the world to share with you how they do that. Please give a warm Sydney welcome to AndyArtz.
Hello, thank you so much for having me today. Unlike Jason, I actually love San Francisco. It's the only city in the world where you can get venture-backed weed delivered to you on an electric scooter. So I'm a happy resident. I'm a partner at Social Capital. And I wanted to talk to you today about something I've been thinking about for a while. It's this intersection between all the concepts that we know to be true in finance and everything I've learned about growing your startup and how that applies to going to market and marketing. So I'm AndyArtz. I started my career at IBM. Then I left, got out of there as quickly as I could to join a gaming startup in the social gaming days called OMG Pop in New York. We spent 5 years making a lot of games that no one played except Asian teenagers in California. And then we made one game that a lot of people played. It was the fastest growing game of its time called Draw Something. Just to give you a sense of the time scale, we launched this in February as the company was running out of money. I fired my girlfriend, and then 2 weeks later, the company was making $1 million a day. We sold the company 4 days after the peak to Zynga for $210 million in cash, and I left a month later. And that's how I joined the dark side of VC. So that's a little bit about me. At Social Capital, our mission is to advance humanity by solving the world's hardest problems. Essentially, we're trying to invest in things that will transform society in a positive way, and doing that in investing in for-profit businesses. So it's not strictly B corporations, it's not nonprofit, but it's also not, we're not going to be the ones that are leading the Series A in Snapchat, most likely. We do that by finding the best companies and then making them better. And tactically what that means, as an introvert myself, I'd much rather have algorithms doing the work for me to source companies. Being on stage and filtering, taking lots of coffee meetings is not for us. So we're monitoring many, many data sets. We spend a few $1 million to buy a bunch of data, and then we're constantly combing through that using a bunch of signals. One example is if you post a director of marketing application on a job site, we see that, we'll flag that and score that. A director of sales application, if you're hiring for them, it probably means that you're growing revenue. So a lot of different signals that you probably don't think about. We're monitoring, tracking to see if there's any potential to invest. Credit card panels are another good source of data where we can see are consumers actually buying and consuming your service. And so we do all that, and one of the unique things that's different about us is when you pitch us, we have a team of 19 folks that will actually log into your database, analyze a bunch of data, prepare a bunch of reports, share it back to you to try to give you a sense of what we're seeing about your business and how you compare to all the competitors that we've seen in those in your industry. And then we spend a lot of time helping our companies afterwards. One of the metrics we track is the multiple on invested capital for the companies we work with. So on average, companies we work with in our portfolio, we don't work with all of them, but there's about a 6x multiple versus about a 2x for the companies we don't. So we like to toot our own horn that we can actually help the companies. And right now we're exploring this really interesting initiative, which we're excited to bring to Australia soon, called Capital as a Service. So we're basically making investment decisions strictly on data alone. The rule is that we can't meet any founder face-to-face or have any human interaction. We've considered about 5,000 companies worldwide to date, and we've written 76 investments. There are a few bugs in the system, so we're trying our best to avoid fraud. I would please advise anyone against applying fraudulently. We will most likely flag you, but if you get through, that would not be good. And it also reduces a lot of bias in the system. So on gender, on race. These are things that we care about a lot. And by eliminating any human component, we can just focus on the data and the quality of the business. How we work with startups. So here's a Series A company we invested in, about $1 million a year in annual revenue back in 2013. We invested early on. We started meeting with them weekly. And we set up these weekly cadence of experiments where we sit down with the CEO, the CMO, the head of growth, and we look at the metrics that matter most. So this is a B2B SaaS business. We started meeting with them in September 2013, and for 11 months, we conducted all these experiments to figure out how do we actually move something that matters here. So in this case, you sign up for the product, and you have to import some data, and if you're a non-technical person, you have to talk to an engineer to get a bunch of data plugged into your system. And nothing we tried was moving. Then we had this idea, what if we borrowed the concept of a Facebook contact importer? When you log into Facebook for the first time, you import all your contacts, and bring that over to a B2B SaaS company. For when you log in for the first time, how do you import all the data about your company into this product? And had a step function change and improvement. So we noticed overnight, holy crap, this was a transformative change for this company. And I show this graph for two reasons. First of all, the time between the two arrows is 11 months. Don't expect these changes to happen overnight. Second of all, when they do happen, the changes that you want to look for are often of this order of magnitude, 2x, 3x, not 5, 10%. A lot of people mistake growth for these small tweaks of optimizing these things that don't really matter. This is what true experiments in growth will result in. Over time, we set our sights on pricing. In terms of revenue retention, this is a graph that a lot of investors will look at a lot. If you're in the SaaS world, you know this graph intimately. 100% of your revenue on month one will usually decline by some percent. You'll have customers that churn. And so this was a company that was doing quite well. Again, it's at 5 million ARR at this point. It raised its Series B, but it had about 10% month one churn. And over time, you can kind of see that continue to degrade. So we came up with this idea of reorienting pricing and switching to a jobs to be done model, meaning that we charge people. We bundle different services together, and we charge people based on the value we were providing, which makes a lot of intuitive sense, but a lot of times it's very hard to test pricing because you don't have, there's a lot of ramifications if you get it wrong. You can lose revenue, you can get nasty grams from users who find out that they're getting charged different prices. And to give you a sense of the order of magnitude of this change, this is 18 months of data for those early cohorts where the revenue was declining after we launched this change. Massive increase, 20 points of revenue retention, and it persisted. This was the single most important thing we've been able to help the company with, and it has completely affected the trajectory of the company. They're now over $1 billion in valuation, doing close to 90 million in annual recurring revenue. And shortly after that, we spent a lot of time looking at their marketing dollars. So if you're running a company, you probably have a chart that looks like this. Where am I spending money? What's the efficacy of that? What are my costs? This is probably as advanced as it gets for a lot of companies, but there's a much greater level of depth we can get to, which I'm excited to share with you today. And so then we helped them with that. That was sort of the end of the 4-year journey we've had with this company to get them to where they are today.
All right, Uber is moving forward, and I love what I'm seeing. They're getting the job done, and they're working on safety and keeping people better connected and protected during their trips. If you take a look, Uber's created a safety center in the app where you can learn about how drivers are screened, what the community guidelines are, and everything they're doing to ensure that everyone who rides on the Uber platform is safe. And you can designate up to 5 family members and friends as your trusted contacts. Then you can set up reminders to share your trip details with them whenever you ride, so they can see you on the map and know when you've arrived at your destination. So, Uber is moving forward. They're doing a great job. They're getting everything tight. And the updated app makes it easy for you to verify the details of your ride. This includes showing you the driver's name, their car, and license, so you make sure you have a great ride every time. They're trying to make it safer. They're making it safer. They're making it tighter. And these new safety center features are amazing. I think it's really well done. So, great job, Uber. And if you want to learn more about Uber moving forward together, go to uber.com/movingforward. Go to uber.com/movingforward. And as a fan of the service, I really do wish them well, and they're doing a great job over there. Great job to the team. Very proud of everybody. Uber.com/moving forward. Okay, let's move forward into the rest of this episode.
I wanted to give you a few tips on how you can be more like this guy. So in 1977, Buffett described to his shareholders 4 criteria on which he would buy his stocks. So he wanted to buy companies that he can understand, with favorable long-term prospects, operated by honest, ethical, and competent people, and available at a very attractive price. So the same principles that he uses to buy stocks, you can think about as a founder to grow your company. So the idea of buying a stock in a business that he can understand should apply to you in terms of building a customer acquisition funnel that's a very simple customer journey that you can tell your grandma, with favorable long-term prospects. This is my favorite thing to think about. How do you know that what you're selling to the market can scale? You know what your CAC is today, you know what your LTV is today, you know what your growth rate looks like, but how do you know if you can continue scaling this $1 million more, $50 million more, to $1 billion? What does that look like? What are the numerical ways we can think about that? Operated by honest and competent people. So if you think about your users, who are your highly engaged, loyal users? How do you find those users? And how do you measure them? And then available at a very attractive price. This concept is thinking about acquiring users as if you would be buying a financial instrument, right? So if you want to go buy a stock, you want to buy an undervalued stock. You want to buy undervalued bonds. In the same way, you want to buy undervalued users. So what does that actually mean? So the first principle, we want the funnel to be one we can understand. I rarely see companies map out their customer acquisition funnel in a two-dimensional space. This is the first place I start with companies when we work together. Think about all the things you're doing and try to create some linear flow. So this is an example of 5 different things at the awareness stage that a company's doing to get them through 4 different parts of the funnel. We can do a little bit better if we think about a flow chart where everyone is in the funnel and say, okay, at a certain stage you're a lead, you're completing a sign-up. If you're not completing a sign-up, what's happening to you? So think about, a lot of people forget that if you stop at a point in the funnel, you're dead. It's actually not true. You go into a different stage. So if you don't sign up, you're actually in a nurture campaign, which is going to email you to try to get you to sign up. It's going to ping you constantly. And so mapping this out is really critical. A lot of people just forget to do this. Once you do that, there's a numerical approach you can take, which says, let me look at every single landing page, email, ad impression that I've served over time. If you're early stage, you won't have that much to look at, so it's a pretty easy exercise. And let me look at everyone who's ever converted to my product, everyone who's ever paid me or done an engaging action, and figure out the probability that that impression or ebook or website was correlated with success. It turns out that there's usually a few core assets, landing pages, that will actually drive conversion. And there's a lot of stuff that's useless. In this case, you can see the team pricing page. Obviously, the company page doesn't matter. Podcast page doesn't matter. So why are you paying someone to make all these podcasts if they're not actually driving conversion? And this is not to say they were the last step before conversion. This was to say, were they ever involved in affecting a user who converted? So principle number 2, we want the businesses to have favorable long-term prospects. So we want the customer acquisition funnel to scale linearly or superlinearly. So when I think about scale, there's really one scatter plot that I love to look at. And it's basically saying, how many customers have I acquired on a cumulative basis? Plot that against how much marketing I've spent on a cumulative basis. And marketing, a lot of people will think, oh, that's just ad spend. Well, it's not just ad spend. It's everything that you've spent money on to go to market. So salespeople, bonuses, CRMs, software integration, data that you've bought. So if you think about that, you've invested all this money. You're an investor. As a founder, you're allocating capital, and you're getting some return on that. So this is a business that was raising a Series B in June 2016, backed by a top-tier VC, and they came in and pitched us. And so we saw this graph, and we said, wow, this looks really good. And then we passed on the company. We didn't have the opportunity to invest at the time. They came back 9 months later and said, hey, we're raising again. We plotted their data on this chart, and we said, oh, something's happening here. They're not growing as quickly as they used to. So what's actually going on? So what we can do here, plot every single month. You can do this for days, for weeks, for months, to say, okay, for a given month, how much did you spend? And spend is a function of all the efforts that you've done to go to market versus how many customers did you acquire? What was the results of all that effort you did? And for that first 12 months leading up to the Series B, things looked quite good. There was some element of linearity involved. After they raised that, they struggled to figure out where they could spend more money to acquire more customers. So the subsequent 9 dots look like this. They spent more money on radio ads. They spent more money on billboards. They hired a bunch of people to hand out promo codes in subway stations. Every single month they spent more and more money, but there seemed to be a capped ceiling to how many users wanted to use the service. So the question I like to think about is, what is true demand for your product? How many potential users does your product serve? And what is the upper limit, if there is an upper limit to the level of scale? Is it an upper limit to your product, or is it actually just an upper limit to the acquisition channel you're using? It's very easy to think about search engine marketing. There's a finite number of search queries, right? So that's kind of the natural analogy, but this is true of your product for anything in the world you do on any channel. So thinking about that, extrapolating that is really something I like to meditate on a lot. And we can do this for all startups we see. So it's not just one startup in isolation, but every startup in every category we can say, how linear, how super linear do these businesses behave? And you can see, here's the company we're talking about. It's basically random at best. They're spending more money, they're just throwing it blindly and not getting any more results to their effort. You can see in the upper right, this company in the orange, R squared of 0.94. It's one of the best businesses we've seen of all time in terms of their ability to predictively acquire more customers. We want the business to be operated by honest and competent people. So we want to find loyal and engaged users. What does that look like? So our favorite graph to look at, which I encourage all of you to run no matter what your scale is. If you're an investor, I would make sure you always ask this question, is how frequently does your users engage on a last 28 days basis? Why 28 days? Because it's 4 weeks. It just removes any bias from any month based on the length of the month. So if you plot the last 28 days, a histogram of the number of days a user engaged, the exact number of days a user engaged, you'll get a graph that could look something like this. On the left-hand side, you'll see that the majority of users only engaged once in the last 28 days. That makes sense. They came in, they tried your product, they left. It wasn't for them. It starts to decline after that. But you see this bump at 18, 19, 20 days. So a bunch of users are using it 19 and 20 days a month. And then you see this other bump at 28 days. So what's going on there? These users who used it 28 out of the last 28 days are your power users. So you have to ask yourself, what are they doing? What is special about them? What are they finding value within your service? This specific company is a chat app for teams, and it has two functions. You can use it in a social manner, or you can use it in a business setting. And so there's no surprise that 19 days out of the month people use it. It corresponds with 5 out of 7 days a week, Monday through Friday for business. And so when you adjust this to a last 28 days basis, people are using this product 17 and a half days a month out of 28 days. Facebook, by comparison, is 19, best in class in the world. Instagram, just underneath that at 16 and a half. And my metrics on those two are slightly old, so I'm pretty sure they've flipped by now. But when you see this, and you see a company where users are falling in love with it head over heels, you can plot this last 28 days. You can also plot this last 90, if it makes more sense for a quarterly use case. This is an instant, for us, this is an instant decision to invest. If you want to go a level deeper, you can say, these axes got a little messed up, but mixed. So there's two types of use cases, social or business or mixed. And you can see, you want to see the smiley graph bend as it goes up and to the right. And what you see is that there's a huge number of users who are using the product for both social and business that are engaged 28 out of 28 days. So what you do when you see this is you go and you write the query to figure out who those users are and ask yourself, okay, what are they doing? They're using both social and business. And another question you can ask is, are they part of multiple teams or single teams? So if you think about, like Asana, HipChat, Trello, Slack, all these companies where you can have be interacting with one company or multiple companies, what happens to engagement of your users as they use more companies? So that you see this network effect start to unbundle. And so when people say network effect, I think a lot of people misuse the words. This is a numerical way to visualize what a network effect looks like. People who are in multiple teams have higher engagement on a last 28 days basis than people who are part of a single team. So just think about that for a second. That's a precise way of demonstrating what a true network effect is. Another thing you can think about in terms of fraud, if anyone's a victim of this, fraud is easily caught by speed at which users are moving through your funnel. So what we'll like to plot is a cumulative distribution function of the number of users who have converted to your app versus time. So you can see on the x-axis, here's time after their first visit. About 80% of people have converted within 13 days. That's where those two lines intersect. And so you have this graph. You kind of every product has a given baseline of how quickly users will convert from your funnel for a given acquisition source. So what this tells us is that as soon as someone clicks a paid Google ad, 60% will convert on the spot. But over time, over the next, call it month, we'll have another, the incremental 40% will convert over that month. So if there's any deviation from this graph, we know there's fraud. We also know that we'll get 60% of the value of our efforts up front. So over time, you can apply a multiplier on top of that to know what your end result is going to be. It lets you run experiments really quickly without having to wait a whole month to capture all of the data. And you can compare it across acquisition channels. So the behavior is very different on Twitter versus search versus Google Ads. This is a really fun trick which helps you understand the psychology of your users. So if anyone is familiar with SEO, you don't know organic keywords that your users are searching for anymore. There's a tool that we have invested in called Keyword Hero. It will connect with your Google Analytics account and probabilistically try to determine that. And so they will estimate what organic search keywords your users are searching for to find your service. This is really relevant to anyone at any stage. Here's an example, a hypothetical example of a flower shop. You can see that users who search for order flowers have spent $265 on average, whereas users who spent buy roses have an equal number of visits but have spent $0. So this gives you a way of understanding on an organic user basis, without spending a dollar, what users are searching for to try to use your product. And the last principle, you want to buy businesses at an attractive price. In the same way with your customer acquisition funnel, you want to try to acquire users at a very attractive price.
Let's take a moment to thank our friends at Weebly for supporting This Week in Startups. And if you've ever thought about quitting your job and doing your own thing, you're not crazy. In fact, you're like 82 million other Americans who said they'd start their own business if they could. Well, Weebly wants to see more of these people take that leap. They want to see you take that leap and turn your ideas into a successful online business. So, Weebly has made it so easy to get started. First, by making it dead simple to create a great-looking website. But second, and more importantly, by providing tools that help you turn that website into a successful business. Let's say you're an artist and you want to sell your stuff online. Well, with Weebly, you can build an online store that makes your products and your brand look incredible. And you can easily manage your inventory, collect payments, run promotions, and even chat with your visitors live on your site. So when you're ready to grow, Weebly can help you get discovered on search engines and create marketing campaigns and get your return customers, all that important high-level marketing stuff. That's your next step after you figure out commerce, which is the step after you figure out how to build a great website. So here is your call to action. Whether you're looking to create a side hustle or your dream job, Weebly can help you grow, and they can help you get your idea out of there. So visit Weebly.com/twist with 2 E's, Weebly.com/twist for 15% off your first purchase. Weebly, more than just a beautiful website. Okay, let's get back to this amazing episode.
Has anyone bought a bond before? Is anyone familiar with coupon bonds? 3 people, great. Okay, so essentially a bond, it's a financial instrument. The way it works is there's some principal up front, there's an interest rate over some period, and you get these coupons that you clip over time. The argument that we like to think about is, the upfront cash outlay, the price of the bond is the CAC, and the coupons and the amount you get at maturity are the LTV. So a bond is simple. You spend some money up front to get a bond. Over time, you clip your coupons. You get paid back for the amount of the bond, and you have the total value. On an ad, on customer acquisition, on anything go-to-market related, you spend some money up front, you get some cohort revenue over time. Right? So your users are paying you variable rates over time. They're expanding, they're churning, and you have some total LTV. It's the exact same thing. So as you think about that, how do you actually know what's going to happen to the price of your LTV to CAC? That's the sort of the analogy of the bond price as you attempt to scale. A lot of folks will look at their LTV to CAC over time, and they'll plot something that looks like this. They'll say, okay, my LTV to CAC is 2x, I'm doing great, but this doesn't tell you anything about scale. Similar to in physics, in the concept, this is not the right dependent variable. You don't actually care about time, you care about scale. So I would argue that you should plot everything that you do as a function of your efforts. And your efforts can be measured in dollars. And so your dollars are how much money have you spent to actually deliver what you're trying to the market. It could be engineering headcount. It could be anything of that sort. What's the efficiency with which you're acquiring customers over time? And so when you do this, you can say definitively this company has generated 2.2x the amount that it spent over the $2 million that it spent. Again, this goes back to understanding the financial concepts. As a capital allocator, how do you get the best price for your efforts? And then you can measure this for companies over time. So this is the example I showed you of the company that was scaling linearly, spending millions of dollars a month. This is what their customer acquisition funnel looks like over time. So they've spent about $50 million. They've generated a 3.1x return on those dollars over time, consistently. The black line shows the marginal LTV to CAC fluctuating from period to period. And you can see that it's very volatile. It fluctuates from 2 to 3 to 4. The gray line is the cumulative results of those efforts. So regardless of what's happening from period to period, you care about the cumulative result over time. And so this is how, if you're a founder, I would argue you should measure your marketers. You should measure the efforts of all your growth. You can also apply this to CAC. So you can think about CAC changing from period to period. It's much different to look at how your CAC changed after $1 million of spend versus $10 million of spend. If you think about everything in terms of plotting it over months, you'll miss this nuance. But if you plot it relative to the amount you've spent, you can see exactly how this behaves. And so we like to think about what's going on here. You can start to see things like this outlier at the end, what's happening. And when you break that down into all the channels that you're spending on, this is a specific company that's spending across 6 different channels. You can see exactly how the returns are distributed across every channel. And the way to think about this is when you buy a YouTube ad, you're buying a bond. That bond will generate some users who will pay you money over time, just like a coupon that a bond will generate over time. And so is YouTube at $446 a good value? That's a question you have to ask yourself. These bonds have a different level of depth too. A junk bond may not have a lot of depth, like an affiliate channel, but it may have a very attractive price. So you're taking some risk reward there. Great, so with those tips, I wanted to give you a little insight on how we think about scaling. Hopefully you two can be like Buffett, and happy to answer any questions.
Okay. Well done. Microphone's right here if anybody has any questions. I see somebody running to the microphone, maybe? Okay. Take your time, we're good. All right.
Yeah, g'day. Awesome presentation, head spinning. Dean's my name. First of all, is there like an online course where people can go and learn all that shit better? Because that was awesome. I'm hoping Social Capital has some resources, maybe, or you can share those slides. Secondly,
actually, we're going to share all the slides in an email after the event. We'll just link to all the decks, so you don't have to.
Awesome.
We'll always do that. Yeah.
So the question was, in order to collect that data, do you have a bunch of tool sets you recommend? You know, like segment, mix panel. Is there kind of a standard?
Great. What tools do you use?
Yep. Yeah. We invested in mParticle, so we're biased. No segment, but segment works too. Google Analytics is good enough for a lot of this, and just any open source database will do. A lot of these are just queries that we run to figure out how users have engaged over time.
Okay. Another question. Your name and a concise question for AndyArtz.
My name is Ben. I have a similar question, which is, how do you recommend keeping these up to date? What's the frequency that you recommend that we update these reports? What kind of granularity do investors expect to see in terms of weekly, monthly, quarterly, et cetera?
Sure, yeah. So when we're working closely with companies, we have what we call a one-pager, which is 10 pages, and it's a bunch of graphs that someone's spending 4 to 6 hours on a Thursday to prepare for the Friday meeting. So it's quite intensive. These are usually Series A companies with 20 to 30 folks. The investor updates tend to be monthly to every 6 weeks. We operate a bit differently because we're in the Slack channels, we're in the weekly meetings, we see all the data, we have access to the database. But I would imagine at your board meeting, at a minimum, you would want these to be refreshed and updated. The ones that matter and where there's outliers. The truth is a lot of these don't change, and that graph where there was 11 months of wandering around, not seeing anything, we'll report on it, but it's not really meaningful. So the thing is to be intelligent about where the actual changes are and curating that and directing people's attention to that.
Great. We'll take another question.
Hi, Paul. A lot of those were B2C. Is there any difference with B2B and enterprise sales, and how would you get the data sets for them?
Yeah, actually, they're both B2C and B2B. So we try to think about every company like a black box. If you're a B2B SaaS company, you're doing some effort to acquire customers. It may be a salesperson who has some metric that they're being measured against, and if they're an SDR, they'll probably be automated eventually. So all these things you can measure and just compare side by side. So B2C, B2B business doesn't matter to us from a data perspective.
Great. And we have time for one more question if somebody has it. If not, let's thank AndyArtz. Well done.
Thanks, everyone.
Okay. Selling. Super important. Whitney Sales. It's literally her name. And she didn't change it. Whitney, did you change her name? It's legitimately Sales. And she's good at that. And she's going to talk about optimizing your sales pipeline. So let's give a warm Launch Festival Sydney welcome to Whitney Sales.
Hi, everyone. So as Jason mentioned, my name is Whitney Sales, born and raised. Let's get that out of the way. What we're going to talk about today is actually how you run a sales conversation. So, there we go. So I work with Acceleprise Ventures. We're a B2B SaaS accelerator. Before that, I actually ran my own startup sales consultancy, working directly with founders and their go-to-market. So I developed a process called the sales method, which is basically the tactical advice on how to actually take your company to market. Before that, I worked with several B2B SaaS organizations, 4 of which were on the Inc. 5000 fastest growing companies list. I've been through 4 acquisitions, 1 IPO, so rapid growth is my wheelhouse, specifically in B2B SaaS. So if there's one thing I want you to get out of this presentation today, it's that your customers will tell you everything you need to know in order to sell to them. It's just about asking the right questions. And there's a whole sequence and process to doing this. And there is an art and science of selling. The art is how you actually do your selling yourself. So what is your personality you bring to the table? And what we're going to do is actually talk about the science of it. So what's the process of this? And again, it's a focus on your customer. So if we look at the overall structure of a sales conversation, this is the way I like to look at it. It starts with context, which is humanity around who you are and as a person, so start with a laugh. I always start with my last name is Sales because it's a great way to break the ice. Then you go into introductions, so who's in the room? Then we talk a little bit about the agenda, so structure of the conversation or meeting that you're having. Then we're going to jump into founder story, which is going to be your initial pitch or use case you're going to have for the customer. And then your qualifying questions to understand if the customer is a great fit. Then jump into the what of the business. So what is it that you're actually going to do for the particular customer, and the ROI that you can actually show them. And then how does this customer actually buy? So jumping into laughter. So a lot of people will just jump straight into a business conversation, when in reality, starting with something that actually establishes the fact that you're human too, you're just trying to solve a problem. So I will find any way to get the other person to laugh. From what I did that weekend in a funny story about me, something I found out about their business, the fact that I'm wired on coffee and talk too fast, because I'm a fast talker, as you guys can tell. Anything. And especially self-deprecation is a really great way, especially as a salesperson, because people always think salespeople are cocky, and it's a great way just to break the ice. Then jump into introductions, roles. So who is actually in the room? What is your role in the organization, and what role do you play? And then who is the other person on the other side of the table? If there's a group of people, this is especially important because responsibilities of each person can differ from title to title. And if you look at how the conversation goes, if you have a lower level person who's actually driving the conversation, or multiple lower level people who are driving the conversation, it may mean that the dynamic in the room is that it's a consensus-based decision-made organization. If there's a higher level person driving the conversation throughout your conversation with the customer, it could be that it's a top-down decision-making organization. So this can be really important to pay attention to. And then finally close with how much time you actually have for the call, because sometimes people switch it up when you get them into the meeting. You may schedule more time than they thought. Next, go into agenda. This is setting expectations. This is really important when you're dealing with larger organizations because they will actually want to know that you're going to not waste their time, and they want to know goals of the conversation. So I'll start by asking them what their goals and what each person's goal is for the conversation. This can be really important, again, if you're dealing with a team sell because each person has different goals. And if you have someone who is checking out or not paying attention, you can actually bring them back into the conversation by tying it back to the goal that they had at the beginning of the conversation. From there, I'll jump into what my goals for the call are, or my meeting. This is going to actually provide you with the structure. A lot of people, when you jump right into questions, if there's not expectations that you're going to start with questions, they'll feel a little confronted by the fact that you're doing that. So if you let them know your goal at the beginning of it is just to find out more about their business, it gives you context to actually ask the questions you need to ask and find out more about their organization. From there, once I get an understanding about what their goals are, I'm going to tell them that I'm potentially going to discuss what I'm going to potentially help them with, if there's a fit. And then outline next steps. And I always start with that being an if versus assuming that it's going to be a good fit, because it lets the customer know that I'm prioritizing their needs versus my own. And then finally, I close with structure for asking questions. So a lot of the time, people can carry about 7 threads of thought in their head at a given period of time. If you don't give them how to actually ask questions throughout the call, they can get distracted and they won't actually engage in the conversation. And so you need to let them know, is this going to be a presentation where questions are going to be at the end, like today? Or is it going to be, I want someone to interrupt me. I want this to be a discussion versus a pitch. So providing that context to them can be really, really helpful in the sales conversation. Okay, so your pitch, a lot of people actually talk about what their product does. In reality, it's much better to give your pitch of your product through your founding story. So how did you come across this discovery? What were you doing beforehand? In that case, you're establishing the credibility for why you're the best person to solve this problem. What was the discovery you actually made about the business? So what is the problem that you realized? And then how did you go about approaching and finding out how to solve that problem and the way that it's the best way to solve that particular problem? And then the context around that. So there's always trends that you discovered around how data was procured, or how a problem was particularly solved, or a gap. Everything was managed in an Excel spreadsheet, and realizing a lot of inefficiencies. So you need to talk about how the trends in the market have changed and what you discovered around that. And then, and you need to make it relatable to the particular customer you're talking to. So if you're talking to someone that's a strategic API that's going to be plugging into their overall business, the application of that is going to be different if you're talking to someone who they're going to be using the product on a day-to-day. And then finally, after you give your pitch, pause for questions. There's almost always going to be questions that come up after a pitch because people want to understand more about what it is that your product does. Okay, so your qualifying questions. I structure qualifying questions in value-based questions and value-based responses. In your qualifying questions, you get 2 to 3. And they're going to be the questions around, is this a good customer for me? So what is it that you actually need to know about this particular customer's business to know if they're a fit for your product? And on top of that, looking at what are the use cases that actually apply to your to this particular customer that you're talking to. Even if you don't have use cases, you can talk about your beta customers, or you can use some of the customer discovery that you actually had when you were learning about the customer, or when you were learning about the product that you were solving. And then the value-based responses, this is actually a key element when you're looking at selling to a customer. Most people, they'll just collect information and won't actually respond to the customer. The value-based responses are the context that you're going to give to frame how the customer should actually be thinking about the problem. So we talked a little bit about trends that you discovered in the market. So for example, one of the companies that I worked with is called People Data Labs. They collected people data and plugged into various platforms. So they plug into your applicant tracking system, your marketing automation system, your CRM to keep the people data up to date. One of the trends that they actually discovered was that 90% of the data today has actually been collected in the last 6 years. And most of these platforms that were built 15 years ago. So the application of having the platform that were built, they were actually missing the data sets that these customers actually needed. And so if they plugged into them and kept them up to date, you had a better application for the customer in the modern day. From here, you're going to jump into use case. So if you notice in this entire conversation and the qualifying call, your first call to establish context for the customer, I never once show the product. I'm demonstrating the applicability and proof that we can do what we say we can do through a customer use case. So it should tell an ROI story. And I have a script for this that Launch actually has, so if you guys want it, I can send it to you afterwards. But basically the structure of it is, when I worked with someone like them, a VP, a C-level exec, an organization, they had this problem too. This is how it applied to their business and the problem they were actually having. And we implemented our product, feature, whatever. The benefit of it was XYZ, and here's how it actually impacted their business from an ROI perspective. So it's a really simple script that you can look at and how you talk about your individual customers from a beta and a use case perspective. So again, you don't actually have to have full customers when you talk about use cases. You can find out a lot in your customer discovery that can be your individual use case. And people ask about them being a customer. It's someone we talked to, did a pilot with, or we learned in our customer discovery. So for early stage companies that don't actually have core customers yet, you can prove it based off of other data. Okay, so selling is actually contextualizing the value for that particular customer. So when you look at this, what do you need to know about the customer to tell their particular ROI story? So we talked about the use case for a customer, right? So for one of your existing customers, what data do you need to know to give that same story for them? So is it something around the type of technology they're using internally? It's usually numbers, or how much time it takes, or how much pain they have. How big is a team that addresses a particular problem? Then in these value-based responses, this is where you use a tactic called spin selling. So instead of educating the customer around the problem, what you're actually doing is empathizing with the customer around the problem. So that's actually something we hear from customers a lot. And in the empathy piece, you can actually use this to overcome objections as well. So you can talk about how, for example, if someone you know your customer is going to have an example or an objection around how a product can be used or how it can get implemented, or that they already have a team that solves this problem, you can use your value-based response and empathizing with the customer and an existing customer you had. That's something we hear a lot. This is how we address that with another company. So it allows you to overcome the objection, again, based on a use case and story, while educating the customer at the same time and understanding that. So in your ROI, so these are going to be you're going to identify the KPIs and story that you're going to tell for this particular customer. And remember that everyone who's in the conversation has to justify the value of your product to the organization that's going to be purchasing it. So the best way you can help them do that is help them calculate their own ROI in the conversation. And everyone's might have, or large organizations typically need a 10, 20x ROI. So how do you help them calculate this? And there's going to be different metrics that you can look at and how the organization actually measures return. So you can dive into this in the selling portion of it, so you can actually then go tell their ROI story for them internally. Okay, now BANT. Everyone knows BANT if you've done selling before. It's budget, authority, needs, and timeline. With looking at BANT, there's a lot of different strategies as well. People talk about CHAMP. I use BANT when I'm actually teaching people because it's the basics and everyone generally knows it. Budget looks at, when you're looking at budget, some of the questions I ask is, how do you typically evaluate tools as an organization? Is this something that you have the resources allocated for? In budget, you also want to look at technical budget. So if someone has to implement your tool within their organization, they may have a 4-month sprint or a 3-month sprint or a 2-week sprint. How do they allocate that, and how do they determine how they're going to spend their resources on your tool? And this can actually impact your timeline quite a bit as well. Authority, so one of the things I run into a lot with people when they're selling within an organization is there's multiple people involved in the decision-making process, or they're starting too low level when they actually get into the organization. So one of the ways to get past this in a qualifying conversation is to ask them, is there anyone else who would need to be involved in the decision-making process? So it's not, are you the decision maker? It's who else would need to be involved? And there's always someone else who's gonna need to be involved. Even if it's a CEO, they're going to need to involve their team to implement the technology. Needs, these should have already been established at the beginning of the conversation. So you're looking at, in your qualifying questions, you understood how you impact their business. And when you actually design their use case, you understand what their needs are when you're selling it and give the ROI. So that's the need piece. And then timeline. Have they ever purchased a tool like this before? What was the process like? And did they have a legal process? Is there someone else who needs to approve security checks? Do you need to get an NDA in place before you deal before you get in a conversation with the stakeholders and have a stakeholder meeting? All these things are really important to actually map the closing process and your initial conversation. Because this specific call is actually helping you understand the context and the foundation of how you move forward within the company. And then finally, next steps. So confirm and schedule the next steps. So what's going to happen when you get off the call? So when you're going through BANT, you're actually mapping what that process is going to look like throughout the organization. So you know very clearly when you get off the call, if there's a fit, who are you going to talk to? Who are they going to talk to internally? When is that next meeting? What's going to happen in that meeting? And then when are you going to schedule your next call? From there, you're going to look at what's their homework and what's your homework. If you don't have homework for them, come up with it. I mean it. It's really important. Specifically because when you're selling it to a larger enterprise, incremental asks that company actually delivers upon are small steps closer to the larger deal. And their follow-through on those tells you how bought in they are. So it's really, really important to have homework for your customer. It could be finding out numbers. It could be getting you an NDA. It could be getting the people that need to be involved in the decision-making process involved. And then finally, always schedule your next step. Don't get off the call or out of the meeting without scheduling it. If you're actively selling as a founder and you're realizing that your process is slowing down, I can almost guarantee it's because you're not scheduling the next step on the call. And even if they won't schedule it with you, get a tentative time. And then what the agenda looks like. So if there's multiple people that are actually going to be on the next call, what do they care about? What do you guys need to make sure you cover? So that you're setting yourself up for success, and the person who's actually bringing you into the stakeholder meeting, bringing you into the organization, actually gives you the details on how to make sure that they're successful and you're successful. Whoop. I guess my last slide's not there. Anyway, so this is the general structure of a qualifying call, and so we can open it up for questions now.
Okay, questions. I see people going towards the microphone with some questions. What's the biggest mistake people building their first-time sales team make?
Building a sales team specifically?
Yeah. And a sales culture,
Yeah, the biggest problems I see when someone's building out their team is they'll hire, founders specifically won't be doing the selling themselves. And they won't understand the needs of the salesperson when they bring them in. Each organization will have its own skill sets that are required. So if you're selling to Fortune 100s, the salesperson's DNA is very different from selling to an SMB. And so you need to understand the DNA of that person and what's actually going to be required of them. That's why it's really important to do founder selling first.
What's the most annoying technique that's being overexploited in sales? Now, because we have this whole sales best practices sort of culture and people sharing and writing Medium posts and tools being made.
Yep.
What's the most ineffective and or annoying thing being done right now that makes you either hate the sales industry or just smack your palm onto your forehead and go, no?
I guess the biggest thing is the culture that you see around selling today. So sales itself is really, in its DNA and its core, is problem solving. And project management, basically. And so people think of selling and they think of the typical like Glengarry, Glen Ross, or used car salesman. There's a really great book by Daniel Pink on this, on To Sell as Human. Selling is part of every single person that has human interactions on a day-to-day basis. So you're selling when you're talking to your VCs, you're selling when you're hiring employees, you're selling when you decide to pivot within the organization and need to convince your employees that it's time to pivot. It's not necessarily a transactional conversation. And so when people think, my biggest problem with sales is people think of sales in this really negative context as deceitful, when really the basis of selling is trust. and problem solving for the people on the other side of the table. So that's probably my biggest problem around it.
Your name and a concise question, go.
Hi, my name is Michael, and I'm the founder of a credit scoring as an API business here in Australia. I have a question regarding how you would answer a particular question I always get. It's more relating to when I pitch the company, they often assess whether they want to build this thing in-house or buy it from someone.
Yep.
Is there a strategy used to answer those kind of questions?
Yes. So when you're dealing with that, you're looking at the mentality of your buyer. So if you've looked at the law of diffusion of innovation, there are specific mindsets of buyers. You're dealing with an innovator. So there's innovators, early adopters, early majority, late majority, and laggards. I suggest everyone look it up if you guys aren't familiar with the law of diffusion of innovation.
What you need to know is there's people who adopt technology
Yes.
early.
Yep.
There's everybody else.
Yes.
And then there's people who are really fucking slow.
Yeah, exactly.
Basically. So there's the people in this room.
Yes.
There's the people who we're friends with. And then there's the people who call us for tech support.
Thank you, Jason. So what you're dealing with is someone who's an early adopter. And so in that, when you're talking to that customer, you need to understand the buy versus build mentality is what is the cost to actually develop? So first you need to ask yourself, is your product a feature or actually a platform? Because if it's a feature, a lot of the times it won't make sense for the buyer. If it's a platform play and actually fits in a larger part of the business, the way you address it is start looking at the other areas that it can potentially expand into. It's selling the vision of where the product's actually going long term and how it will impact the business, and then looking at their internal resources and their internal resources' ability to actually execute on building that. Because if they don't have the resources to build it, you can look at how long it's going to take them. And it just doesn't make sense, especially for enterprise organizations. It's insane how long it'll take them to just put in a little nugget.
Another, and dangerously close to the grown, so be careful there. Your name and your concise question.
Hi, I'm Rachel. So my question is there a difference in approach that you need to take if they are your first customer? So you're asking them to take a leap of faith in a venture that's unknown.
Yes, 100%. So when you're dealing with your first customers, usually around your first 10 customers, they're partners more than anything, more than customers. And so you need to take the approach of looking at them, are they a good customer for you? Because each of your initial customers is a spoke of your next group of customers. So Paul Graham has a really great quote that it only takes 10 customers to get to 100. And it's because you get to replicate each of the use cases for your existing customer base. So your first customers, take care of them and hold their hand and make sure they stay with you, because every VC is going to be looking at your churn. And that customer will help you push your value in the market if it's a great customer for you. There'll be references, et cetera. So again, they're a partner versus a customer is really how to approach it.
Okay, let's give it up for the one and only Whitney Sales.